First of all, types of accounting transactions. Well, broadly, there's generally three categories that need to be accounted for. Sales, as of course they occur. Purchases, for example, purchasing raw material or equipment. And payroll, often one of the largest sources of money flowing out of an organisation, that is, paying the wages and salaries of your staff. Now, historically, these three categories were recorded by hand in large books. Now, these days, of course, they're done by computer. However, names such as ledgers and journals from those old times still persist. So get used to these phrases, even though they'll be carried out in a digital form. And in terms of accounting transactions, wherever there is a transfer of value, a transaction needs to be recorded. We'll see how that happens. Now, something called double entry bookkeeping has been around for quite a time now, and it has become pretty much the standard approach that is used. And it's based on the fact that each transaction in a double entry bookkeeping system is recorded once only, however, but it's done in two places because each transaction has a dual impact on the organisation. We'll see in a few simple examples in a moment. Point number one, for each item that is purchased, the organisation has gained an item of value. However, on the other side of the coin, if you will, it also has a liability to pay back whoever it was who supplied the item. The second point is that when an item is sold, the organisation is obliged to supply the goods to whomever we sold them to. But on the other side of the coin, yet again, we're expecting whoever we sold them to honour their promise of payment, received of course from the organisation's customer. A very, very simple example here. Suppose if you wanted to purchase a hamburger from a fast food chain. So what happens here? You go in, you queue up and you buy the hamburger, possibly a hamburger meal. You gain the hamburger and of course you lose the cash. Looking at it from the perspective of the fast food chain, they have lost an item of stock, the hamburger. However, they've gained the cash that you paid them for the hamburger. So here, although it's only one transaction, in an organisation's financial records, you'd expect both sides of this to be recorded. Let's now look at the ways in which that occurs. So double entry accounting, we'll be looking at this in a lot more detail in future modules, is basically a left-hand side and a right-hand side, hence my big thick black line down the middle. The left-hand side is historical. It's based on what has happened in the past, and it captures the assets, the owner's equity, if you will. And it consists of elements such as borrowed money, that's an asset, the organisation can use it to buy whatever, and persuading investors, the stakeholders if you will, to put money in the business as owners. And third, purchasing assets on credit, and while we're doing that of course, making a profit by whatever it is we're selling. So that would be the left-hand side, the assets. A reminder of the formula here that assets equals equity plus liabilities. What about the right-hand side? This looks at the future, both liability claims as well as their sources. Now, each asset source can have a different type of claim. Some sources might be charging interest, such as a bank. Others won't be. Some must be paid soon, possibly within the next month. Some much later, possibly years later. Now there are many examples here of where some might be paid soon or some later. For example, you may have, like I did, an accountant that does a lot of work for you during the year, but you don't pay him until the end of the year. It might be that your business has unpaid bills for utilities such as telephone, gas, electricity and water that's used during the year but not paid until later. Put simply, there's three different types of operating liability accounts that would record a business's unpaid expenses. You're familiar with accounts payable. These are usually for items that the business buys on credit and for which it receives an invoice, a bill in effect. Then there's even accrued expenses payable. This is where the business knows it's going to get a bill, but it has to estimate what it is because it doesn't know precisely. And then, of course, there's the dreaded income tax payable, both for income taxes, corporation tax, and so forth. So let's start with profit then. Profit known as net income. Profit can occur where you have an increase in assets, It can also occur when you receive sales revenue, less expenses of course. Now assets have sources, and these also are claims of one sort or another on the assets of a business. I've just mentioned some of the sources up here. Owner's equity. This is how much capital they, the owners, have invested in the business in the past and how much profit the business has recorded. Unlike liabilities, the owner's equity is tied up in the business indefinitely. That's a distinct difference. And it's also important to remember that profit comes not from increasing liabilities and not from additional capital infusion from the owners, as I'm sure you understand. Remember the formula: profit equals revenue minus expenses incurred. Liabilities, meanwhile, are those that will be paid back at their maturity dates back to the creditors. Here you see is the difference. They've got maturity dates, whereas owner's equity has no such thing. Now, the nature of business activities could be defined as economic exchange in order to pursue its financial objectives. Let's give you a few examples here. Let's say a business borrows $10 million, which is an increase in cash. For what? Well, the business promises to return the loan at a future date. So this is a liability. Thus, the company's debt increases. However, the loan interest is paid in exchange for the time value of money. In other words, they've got this money to use now to make a profit soon and then pay the money back over some period of time. I'll cover the time value of money in a lot more detail when we look at investment analysis with business cases in a much later module. Another example, a business buys products that later it will resell to its customers. This same business gives money for the products to the seller. So suppose the product is a washing machine. They would be buying electric motors and parts from the sources of supply. So that as the company does this, the company's cash decreases. However, at the same time, the business receives the products and therefore its stock increases. Another example of the need for double entry accounting. In this case, a business sells its products and receives cash or promises to pay. Thus, the company's debt increases, and because it sells the products to the customer, the company's stock decreases, much like our hamburger. The business sells the products for more than they cost, hence they'll make a profit, from which other expenses may also have to be deducted.